Welcome to the session. Beginning to know your true costs. A question before we start. You only need to provide the answer to yourself. What is your current cost of operation per mile, your current revenue per mile, and your current operating ratio? These 5 following sessions will enable you to provide answers to these questions. Spending $100 to make $90 is a highway to disaster. Cost awareness matters. An awareness of the costs associated with generating revenue is essential to survival in any business. The difference between the cost of revenue and revenue is profit margin. How much revenue is profit, not expense? 6 to 10% is considered an average profit margin in transportation. The variation is due to many factors: equipment costs, maintenance costs, driver wages, fuel, taxes, and fixed overhead costs. However, knowledge and management of costs involved is a primary element. A single, unmanaged cost can wipe out annual profit. Let's assume a profit margin of 10%, a revenue of $2.55 per mile, annual miles of 100,000 miles. Management missteps or mistakes can easily erase the $25,500 of profit generated from these numbers. Look at it in this way: $2,125 a month, $475 a week, or only $68 a day. That's only 19 gallons of diesel. Failing to look at numbers in this light removes us from the light of survival. Cash flow and profit are not synonymous. Cash flow indicates a steady flow of cash into the checking account. Cash in, check out. Profit indicates that revenues exceed the expenses, and the checkbook has a balance. When cash flow is interrupted, the checkbook groans in agony as the expenses remain and the cash has disappeared. The adage, "the harder I work, the behinder I get," should be familiar to us all, because it is true. Just because we are busy does not mean that we are profitable. Grandpa always told me, work smarter, not harder. I believe that this is a wisdom that we can all live with. Cost awareness should always be foremost in our thoughts and actions if we are to be successful in whatever path we choose to follow on this journey of life. The highest category of cost is driver compensation. Owner-operators should always consider paying themselves as employees and including it as a direct business cost. Basically, you are your own employee. You deserve a wage when you're driving, and you deserve to make a profit from the business as the owner. These are two different elements: functionality and economically. If you do not include driver compensation in the cost of operation, a valid cost of operation is not being determined. Fleet operators need to include all taxes for W-2 employees and accounting costs for 1099 individuals. Safety bonuses and incentives are also a driver compensation cost. The second highest category of cost is fuel and fuel taxes. Surtax exists in multiple states. It is important to know which states have a surtax and what that surtax is doing to the cost of mile of operations. IFTA is another area that can be problematic. Purchasing excess fuel in a state with lower fuel taxes can be counterproductive. As an example, purchasing excess fuel in Indiana and not purchasing fuel in Pennsylvania. Yes, a refund and credit are provided for the excess fuel in Indiana. However, that credit and refund amount is less than half of the tax due for unpaid gallons in Pennsylvania. Excess idle time is wasted money. Cruise control speed set at less than foot speed. Cruise control can get better mileage at foot speed than the driver can. Cruise control set to the efficiency of the vehicle gets better mileage than set to an arbitrary speed. Little concerns create big differences. Ben Franklin was perfectly correct. A penny saved is a penny earned, and those pennies can add into dollars very, very quickly. Change of equipment inventories creates a change in the cost of operation per mile. Inventory payments are direct operating costs and should be figured into the cost per mile of operation. Depreciation is better left to the accountant. Depreciation expense is a non-cash expense that reduces the company's net income or profit and should be considered in the cost per mile of operation. Accumulated depreciation is considered as an asset. Again, the realm of the accountants. Maintenance and repair costs are manageable. However, to be effectively managed, they require detailed documentation. Effective documentation enables the identification of trends. Response to trending can replace a major maintenance expense with a less costly preventive maintenance expense. Tires present a significant expense. How often is the PSI actually gauged in your equipment inventory? Underinflated tires are the primary cause of increased tire wear, decreased fuel mileage, and sidewall failure. Maintenance and repair procedures performed on the road always have an increased cost factor due to downtime, missed delivery, and pickup appointments, and customer and broker dissatisfaction. And this does not include the added expense of over what it costs you to do it in-house or locally. In-house preventive maintenance programs save money. What is your cost per mile for liability, physical damage, equipment repair, deductible payments, and paid claims? If accurate crash and incident reports are not maintained, this cost is probably not known. However, it is a cost that should be known. What amount of deductible should be carried? Can the difference between the insurance rate between a zero deductible and $1,000 deductible be compared alongside your loss history? The more detailed your crash and incident loss history, the better the opportunity to negotiate rates. Meanwhile, meetings with the insurance agent should occur on 6-month cycles. Policy activity should be completely reviewed with open claims discussed. Closed claims should have no reserve funds assigned. Open claims reserved funds should be appropriate and the loss ratios discussed. These are all methods to control and manage the cost categories that comprise the cost of operations that you incur. A cost per mile calculator is provided with this presentation. When an object fails to displace a volume of water that is not equal to its weight, the object fails to float. When a business fails to generate revenue that exceeds its cost of production of revenue, that business fails to float. Hidden costs, costs that are not reflected on a general ledger, not documented, or are indirect costs associated with operations, are silent profit killers. Effective management can mitigate hidden costs. Every truck in the fleet should stand on its own. Fleet averages are nice, but it's nice to know what each truck is doing. One truck can easily erase profits generated by several trucks. We all like to reference the bottom line. Well, the bottom line is know your numbers. Know what is coming in, know what is going out. Know the cost of everything you touch and do. Track the cost per mile for each traffic lane. Know what trips make you money and what trips do not make you money. Each decision you make either puts money in your pocket or takes money out of your pocket.